Hi, good morning. Let's look into the meaning of long-term financing. There are different methods of financial instruments that are used by the companies for raising the funds from the public as well as from outsiders. Equity shares, debentures, preference shares, term loans are the most important long-term methods of financing used by the company for raising the funds from public as well as from outside to meet the financing needs of the business. Let's look into one by one. The first one is known as equity shares. Equity shares provide ownership title to the shareholders of those companies. Equity shareholders are known as the owners of the company who have the claim on the income that made by the business. The company make profit of 1,25,000 rupees. Equity shareholders have some claim on this profit made by this business. At the same time, the company maintain an asset of 25 lakh rupees and the company decided to sell off the assets and they're getting profit of 2 lakh rupees. So on this 2 lakh rupees profit, equity shareholders have some claim on the profit of the assets that made by that business. So definitely equity shareholders have claim on the income, equity shareholders have claim on the assets that held by that particular business. At the same time, equity shareholders are known as the so-called owners who have the complete power and authority to control the whole affairs of the business. Then the next one is equity shareholders have the voting rights of the business. They do have the voting power and they have the complete control over the affairs of the business. They are known as ordinary shares or equity shares. Let's look into the category of equity shares. The most important type of equity share is known as blue chip shares. These are the shares of large, well-known, high market capitalized companies. These are the shares which are known as blue chip shares. Example, you know that, Sensex, 30 big companies coming in the Sensex. All these shares are known as blue chip shares. Then the second category is known as growth shares. Shares of those companies that are growing, which means that all the fundamental indicators of the company is growing. Sales is growing, profit is growing, return on asset is growing, return on net worth is growing. All these fundamental indicators of the company are growing at a higher rate. Such kind of shares are known as growth shares. Third category of equity share is known as income shares. These are the shares that provide stable dividend return to the investors. Such kind of shares are known as income shares. Tata Steel is one of the type of shares. Ashok Leyland is another category of shares providing attractive dividend to the investors. These are known as income shares. And fourth one is known as cyclical shares. These are the shares prices that will fluctuate according to the seasons. Off seasons, share price will reach at the bottom level, and peak season, share price will reach at the top level. So likewise, such kind of fluctuations are taking place for the share prices. Such kind of shares are known as cyclical shares. And last one is known as defensive shares. Share price will never fluctuate very widely whatever happens in the stock market. Such kind of shares are known as defensive shares. These are the types of equity shares that are available in the market. Let's look into the advantages and disadvantages of equity shares. One of the most important advantages is actually the equity shares actually giving the permanent capital to the business. Permanent capital, it is not for 1 year or 2 year capital. You will get the capital over long term of the business. That is one of the attractive thing of equity shares. And it's used for raising the funds from the public directly. Directly you can issue the shares to the public and you can borrow it. It's a best method of borrowing. And the third one is dividend payment. You want to make the payment of remuneration to the shareholders as dividend, but it is completely based on the discretion of the management. Management can decide whether to pay dividend or not. So that is another attractive thing of the equity shares. And what are the disadvantages? Definitely, if the shareholders are putting some amount to the business, they have certain expectations. The minimum rate of return expected by the equity shareholders are much higher than any other source of methods. So the cost is somewhat high for the equity shares. At the same time, there is a risk in it. Then earnings dilution and ownership dilution, which means that a lot of shareholders are joining with the company. When you are sharing the profit, your profit will be very less. So that is another thing. A lot of shareholders are joining with the company. This can happen. Earnings dilution and ownership dilution can happen for the ordinary shares. Let's look into what is right issue. As you all know that right issue means selling the ordinary shares to the existing shareholders of the company. That's known as right issue. And public issue, you know that directly selling the shares to the public, that's known as public issue. So these are different methods of issue of equity shares. Let's look into the next instrument, which is known as debenture. Debenture is basically known as a debt instrument issued by the company for raising the funds from the public, offering a particular rate of interest to the holders of this instrument. That's debentures. What is the feature of debenture? Debenture is actually promising to pay the interest rate or coupon rate. What is coupon rate? Coupon rate is known as the interest rate that mentioning on the face of the debenture is known as coupon rate. If the face value of the debenture is 100 rupees and 10% is the coupon rate, 100 into 10 by 100, 10 rupees is the coupon amount or interest amount. This issuing company must pay this 10 rupee as interest to the holder of that instrument. That is the feature of this debenture. Maturity period will be mentioned on the debenture. If it is for 5 years, after 5 years, the debenture's term period will be over. So before maturity period, if debentures can be redeemed, which means that the holder of the instrument can give back this instrument before 5 years, third year you are giving back this instrument. Some instruments it is possible, redemption is possible. And next one is yield, is known as basically the rate of return provided by the debenture is known as yield. So these are some of the features of debentures. Face value is one of the most important thing. Interest rate is the maturity, redemption, security, yield. All these things are coming under the features of debentures. Let's look into the types of debentures. There are three categories of debentures. One is non-convertible debenture. These are the debentures which cannot be converted into equity shares. Such kind of debentures are known as non-convertible debentures. And fully convertible debentures. These are the debentures which can be converted into equity shares after some time period. Such kind of debentures are known as fully convertible debentures. A part of the debenture can be converted into equity shares. A part of the debentures are not convertible into debentures, not convertible into equity shares. Such kind of debentures are known as partly convertible debentures. A part of the debentures can be converted into equity shares. A part of the debentures are not convertible into equity shares. Such kind of debentures are known as partly convertible debentures. Let's look into the advantages and disadvantages of debentures. It is less costly. So once the coupon rate has been mentioning on the face of the debenture, this is the cost associated with the debenture. There is no ownership dilution. If the owners are not joining, TCS is actually using debentures for raising the funds from the public. So what is the advantage of that? Shareholders will get more attractive EPS. But the debentures, you will make the payment of interest to the debenture holder. Debenture holders will be very happy with this particular situation. And it's an obligatory payment. Disadvantage is it's an obligatory payment. Definitely you are supposed to pay. It is the liability of the company to make the payment of interest to the debenture holders. So there is a risk in it. Every month you want to make, attractive profit from the business. For making the payment of interest to the banks and financial institutions, you need to have more cash outflows, which is needed. These are some of the disadvantages. Company must be able to cope up with the situation according to the total amount of money that borrowed by way of issuing the debentures, which is very needed in the organization. Let's look into all these things. These are the two types of instruments that are available in the market. And third one is known as preference shares. It is just like equity shares, it's just like debentures. Preference shares, all the features of equity shares and debentures. So in the case of preference shares, dividends are not deductible for tax purpose. And it has no fixed maturity date. That's why it's just like equity shares. And it's almost like debentures only because of one reason. The debenture holders does not have voting right. And dividend rate is fixed in nature also. That's why it's also called as debentures. So preference shares are known as hybrid securities. Shows the features of ordinary shares and debentures. That's all about preference shares. They have the claim on the income and assets. They have got a fixed dividend amount. The dividend is cumulative in nature. Redemption is possible. Convertibility is also possible in the case of preference shares. These are some of the features of preference shares. Thank you.